What is up, YouTube? This is the Working Investor. Today, we're going to talk about my June update and phenomenal return, what my strategies are, how they've changed in June compared to May and previous months, and what my strategies are going forward to provide inspiration for the nation. Basically, this is money that I am trying to have a goal of generating $1,000 a month outside of my labor of trading my time for money with different sources of income, including selling options via the wheel strategy of selling cash secure puts and covered call. I have been doing a little sprinkle of high yield dividends as well, but that's a very small percent so far of my earnings. And my goal is to hit $1,000 a month. And I thought I would hit that goal in May, but I've hit the goal in April. My goal has been superseded in higher magnitude and in quicker duration as I get better and better at what I do, and as the market cooperates. It looks like I've been going up from 400 to 1,000 to 1,600 to 2,000 now, and my capital hasn't changed much. It's just my strategies have changed. And I've gotten pre-tax, because you do have to pay the piper, you got to pay taxes, but pre-tax so far for the year I've netted closed, these are all closed trades, $5,236. My monthly average, starting since I've been tracking it since March, is $1,309. I was thinking once I hit a monthly average of around $1,500, then I may consider upping my goal from $1,000 a month to $1,500 a month. Now the quantity, the size of how much I have in return, it's all relative to account value. And most important thing is annualized return. Whether you have a smaller account or a bigger account, it depends on your annualized return. You're using your buying power cost effectively is what matters. So right now I'm working with about $80,000, and my return on capital, my ROC, and on an annualized basis based on this month is about 31.4%. The way how I do that math is if you take 2,065 which is the amount of money plus change that I received this month, divided by $80,000 in capital, you multiply that by 365 days of the year, and the month of June only had 30 days, so you divide it by 30 days, and you multiply that by 100, that gives you a 31.4%. And if you analyze this return on an annualized basis, return on capital, not revolving capital like I do show you in my slides, but because I open and close trades, but just return on capital, it's 31.4%. Just to show you what I do and how I calculate different things, you'll see here if you do analyze return, on revolving capital is 24%. Why do I say that? Because as I open and close trades, I'm using different amounts of buying power, and I'm cycling through that $80,000 several times, multiple times over through my short duration options in the month. So my entire buying power that has been revolving throughout the month was $616,000, but it's been open and close, open and close, open and close. And that's how you see the annualized return on revolving buying power was 24%, but actual annualized return on the capital was 31.4% return. So as I'm sure you guys figured out over here from my previous videos, and you can see over here, my strategies for this month have been leaning a lot more to 0 day to expiration to sub 7 day to expiration, in my strategy. You can see that if you look at my total days to expiration, you'll see here my average day to expiration is about less than 7 days, 5.08 days. This is also a little bit exaggerated because I had some old positions that I kept rolling in SPY, which is now closed. But if you compare that, let's say, to May, you'll see that my average day to expiration is almost 15 days. So I went 3 times closer to expiration, and my annualized return on buying power was a lot less. And you'll see there was 10 days in April and 15 days in March. So you could see that from 10 to 15 days, I've gone down to almost like less than 7 days to expiration. So everything has been, theta decay is accelerated. And most of my trades, a lot of the trades I've been doing where I've been doing a lot of IWM, which is the Russell 2000 that has daily options. So a lot of them have been like, this is like 2 days to expiration. I had to do some 5 days because I had to roll something, but a lot of them you'll see when I write down 0.5 days, it really means 0 days, but the calculator can't compute 0 days. It messes up all the math. So I do it is technically like a half a day because it's only partial days. So I just put 0.5 days to expiration. But you see, I've done a QQQ, another QQQ 1 day to expiration. I've done I guess it's really a 0 day to expiration. Amazon, a 0 day to expiration. A lot of 0 days to expiration. I do some leverage products. It's called a TQQQ, which is the triple leverage NASDAQ, which has triple the implied volatility, which gives you a nice amount of premium. The premiums have been phenomenal with these, but there is a lot of inherent risk. Getting 448% annualized return on buying power is a lot, but there is a lot of risk with it. But I'm comfortable with this risk. I've been trading these products. Even when things went bad, I've seen the good and the bad and the ugly and everything in between. And I've also been doing some TNA, which is the triple leverage Russell 2000. So if you notice a trend here, there's the QQQ, and then there's a TQQQ, which is the triple leverage NASDAQ, triple leverage NASDAQ. And then I have the Russell 2000, and then I have the TNA, which is the triple leverage Russell 2000. So I've been doing basically similar products, just kind of in different styles. And I do have, when you see the Amazon, I do have a leap option Amazon, which we'll get through when you look at my future. So we talked about the update right now in June. We talked about the strategy that's mostly sub 7 days IWM, Russell 2000, QQQQ, mostly sub-weekly. And then some news was that I got in trouble with Robinhood because I didn't know about this, but I know what a margin call is, but I didn't know there's something called a day trade call. So when you go into a brokerage, there's a certain amount of money that you could have available for day trading, and I superseded that when I opened and closed a position in the NASDAQ, in the triple Qs, and then I opened another position end of day for the following day, and it was too much money cycling in and out, so I had to put like $12,000 into the brokerage, but I only have to keep it in there for about 2 trading days, and then I could take it back and take it out of the brokerage. So it's just temporarily there, just hanging out there for a little bit to make the brokerage happy, and then I'm out. But now I'll be more mindful with how much I can do intraday day trading. So I do news for me. So for July, my plan is to do the same plan as above, doing the sub 7 day, 0 day, 1 day, primarily sub 7 days on the triple leverage products. I do have, as if you guys remember from a previous video, and I'll just reiterate if you haven't, I do have leap options as well. I'm a big fan of leap. I got inspired by Options with Davis, where this guy showed that he generated 6 figures of income just with, I think it's about 1 leap option in Meta and like 6 leap options in the triple Qs. And some of them have been like 10x return or something like that. And basically, as a wheel strategy collector, I'm primarily not enjoying, I'm getting a lot of premium, which is amazing annualized return, but I also want to enjoy some exposure, some upside exposure of the market, especially if you're sort of in a bull market. So basically, I'm very, very long on Amazon. So I did buy about a month ago or so, deep in the money call. It was a 150 strike price of Amazon when Amazon was trading at 182 approximately per share. It was trading at $182 and change per share. I bought a $150 leap option that expires the end of 2026. So I have about 2.5 years to be right. And I paid for it $65 per share. So a contract is 100 shares. So I paid $6,500 for the 100 shares, but it's $65 per share. If you do the math, if you take 65 and you add it to 150, that equals to $215. So it means that my cost basis anything CB, I wrote here CB as cost basis. Anything above $215 is a net profit for me on Amazon. So I'm basically betting that Amazon's going to go from, the time I was trading at 182, it would go above 215 in about, and I have time to be right until, sometime I think mid-December 20, maybe December 18th, mid-December 2026. I have 2.5 years to be right about this. So I could be wrong for even 2 years and 5 months, and on the last month it could be right. Amazon is, if you look at it, has a very positive drift. I personally, this is my personal, don't copy what I do, but this is my personal bias that I think Amazon a phenomenal company. And I'm willing to put $6,500 to, I'm not just saying it, I'm putting $6,500 up. And right now, Amazon jumped up to in the $190 range. And I was able to, my option that I paid $65 for, or $6,500 for, because it's 100 shares, was worth $7,300 to $7,500. So if I want, I can go ahead and close it at this moment. Well, when the market opens on Monday, depending on where Amazon is, I can close it for about $800 to $1,000 profit in a month, which is phenomenal. You don't have to hold it all the way to the end. But another good thing is that because Amazon drifted up, I was able to sell a short call, or sell a call basically at my strike price at $215. But then Amazon went up even further, so I rolled it up. So you could see I rolled it up further. So I collected $65 in premium. I collected $50 for selling the 215 strike price, so it's basically at my cost basis. And then I rolled it up to, I believe, $225, expires on 8/2, so it's after the earning. There is earnings coming up 8/1 after markets, and it's a 225 strike price. So that means if my cost basis is 215 and I sell it for 225, that's $1,000. And so I'm agreeing to get rid of my Amazon long call for $1,000 profit, or I can roll it. And it was a 0.1 delta. So that means that I have a 90% chance of win rate. So the odds of me, not losing my shares is 90% in my favor. So I collected 50 to roll it up. I got a net credit of about $15. So I received $65 total net credit. If you think about it, $65 in $6,500 is 1%. 1% return in about a month, and because it expires 31 days from the time I made the trade, and that's about 12% annualized return. So there is something called the risk-free rate. If you try to buy, you put your money into a high-yield savings account, or you want to buy some certificate of deposits or treasury products, which we consider the risk-free rate. Right now, they're paying about 5%. 4.5%. I think you can get it like 5.5, 5.25, between 5.25 to 5.5 at most is what I've seen. So I kind of want to, at least while I'm hanging out with this leap option, like a secondary goal is to get a little trickle of money, but try to beat the risk-free rate. So if I had the $6,500 in a certificate of deposit, treasury products, or high-yield savings account, I would make 5% return annualized basis. But here I'm making a 12% return. So I'm definitely beating the risk-free rate just by sitting and waiting for, Amazon to go up. So it's been so far a very good trade. I got a little gutsy and I put another poor man cover call. I bought my first poor man cover call in IWM. And it was a deep in the money. I put here 100. The 100 means that the strike price was $100. IWM is the Russell 2000, and I paid $10,750. I know that sounds like a monstrous number, but IWM, I'm right now controlling 100 shares of IWM, and they're trading for somewhere around the $202 a share times 100 shares. It's $20,200. So I'm basically controlling 100 shares of IWM for almost half the price. So I'm basically double leveraged on my money. So because I paid $10,750 for it, so that's basically $107.50 per share. So my cost basis is 207.5 because $100 plus $107.50 is $207.50. So right now I'm able to sell basically a covered call, like a short call against it. So I did do that, but I did the weekly. I wasn't able to do the daily. There's not enough meaningful premium for the daily. So I've been doing the weekly for now. I think I did a 208 strike price, so just above my cost basis. So worst case scenario, if IWM would blow past 208, I have an option to either close it, roll it, or I can go ahead and just let it do what it does and then lose my lose it for a profit of $50 profit, plus the premium that I received in 1 week. So it's not a bad worst case scenario whatsoever. So that's where I am right now. So basically I'm trying to implement some poor man cover calls because you see I'm doing the NASDAQ 2000 for cash, but I'm also leveraging some money to increase. So instead of making one trade per week, I can make two trades per week. Two trades eventually, hopefully per day with the NASDAQ 2000 with my leverage product. This is the Working Investor over and out. I hope you guys are well. I hope that the market finds you favorable, and hopefully one could stop trading one's time for money. And if one wants to work, one could work on their, genuinely if they want to, but everything will be optional on your choice. Live life on your terms. I hope all is well. This is the Working Investor over and out.